I just want to remind people that we're still in record valuation territory for the S&P 500, and this is looking at the price to book ratio, which is up there right close to the highs for the S&P that we had at the peak of the tech bubble, which was one of the most frothy valuation markets that we've ever had. The tech bubble in 2000s. Of course, we believe we are in another tech bubble right now, an AI bubble, and we think it's at the point of getting ready to unwind ahead of a recession. We have a number of macro recessionary signals that we have been talking about in our calls here and in our research letters. I'm not going to get into all of those this time around, but it was just 2 weeks ago we had a sell-off Friday and then a further sell-off over the weekend as the yen carry trade unfolded, and as we learned that Warren Buffett sold almost 50% of his Apple. But in the last 2 weeks, the market has rallied back where we're only like 2% away from prior all-time highs. So however big that correction was, I don't know, it was like 8% or so. We're practically back up to all-time highs again, even though we had the 13F filings come out yesterday, and we saw that some of the well-known and smart hedge funds were actually net sellers of their Magnificent Seven stocks. We still had a broad retail investors just climb back in and buy the dip here, and personally, I think we are still at another historic equity market top, especially for large cap growth stocks. But it's a broad stock market top here in the US that we are only just back up here retesting. We still have a number of short positions in our global macro and long short funds to take advantage of this likely market correction ahead of a recession. It's not that we don't have a bunch of long positions too. We are positioned for the great rotation that we have been calling for some time, and it's finally starting to arrive, and you're starting to see some of that rotation, especially in the metals stocks. But let's go on to the next. One of the biggest risks in the marketplace today that we see is really this flow into passive investing strategies. This from BofA Global Research shows that since 2008, that passive index funds have had $4.9 trillion of net inflows at the same time as actively managed funds have experienced a $2.6 trillion outflow. Back in the day of when index funds were first invented as an academic theory, there was the whole idea behind them was that there's enough smart active managers out there doing the research, doing the due diligence, doing the fundamental and valuation analysis that all that information is already going to be priced into stocks, and therefore a passive strategy can has a chance to be less costly and to outperform active managers. Well, since 2008, passive has been outperforming active, but we think it's just part of this whole bubble, part of the bubble created by the Fed itself and keeping interest rates artificially low and printing money, supporting this inflation of asset prices and asset values. I do believe the great rotation is going to be about money rotating out of passive and out of overvalued mega cap growth, certainly into undervalued value stocks, actively managed strategies, smaller cap stocks, foreign stocks. This has been an S&P 500 index bubble. This is just one of the factors that has been contributing to it, is the massive overweight that we have in passive index strategies. Let's go on to the next. This is from the Financial Times. an article on value stocks relative to growth stocks, and the relative price to book value on this is looking at all developed markets, so not just the U.S. The relative price to book value of value stocks versus growth stocks. It's like 10%. Growth stocks are like 10 times higher price to book than value stocks, which is one of the highest relative differentials that we have ever had. And it's just another indicator, that, growth and value investing, does move in cycles. I think we are due for a rotation into value strategies out of growth strategies. But the great rotation for us is really about navigating this more stagflationary environment that we have. Let's go on to the next. And so it's a much narrower group of value-oriented stocks that we're interested in. This is just another look, because today retail sales came out. It's another look at this is one of the recessionary indicators that we see, and it's just looking at furniture and home furnishings, that component of the retail sales report on a year-over-year basis, clearly in the negative territory, looking kind of like the 2008 recession. And it just shows that people are not spending on big ticket consumer discretionary items. This is a recessionary signal. Let's go on to the next. This guy who's been posting on Twitter, and he's been on Fox News. He has some really interesting charts. EJ Antoni. And this is showing, also looking at the retail sales numbers since 2021, and showing the retail sales. That the estimate is 14% above where it was in April of 2021, but it's down 3% in real terms over that same time frame. And so businesses are selling less stuff, but at much higher prices. This is just another picture of stagflation and this very unique stagflationary setup that we have for an oncoming recession, and why it's really important to be looking at the types of, as we look forward to when the Fed is going to finally start easing, and what are the types of industries that will outperform in the early stages of coming out of a recession, which the market will discount even as we're going into the recession. There are industry groups that will be going down and dramatically underperforming if we go into a recession like we believe. And then there are new industry groups that have already been decimated, but will be the beneficiaries of lower interest rates and the new investment business cycle. And that's where we want to be focused. That's why we are so heavily focused on precious metals and base metals today, because this is where the opportunity is. Let's go on to the next. So the Michigan surveys, of course, came out today. Again, these things come out monthly. Why do we pay attention to this? Well, because there's not only the overall consumer sentiment index, which has been declining and is still relatively depressed, signaling an oncoming recession, but also the inflation expectations survey, which they have, and we have shown this consistently, how the median 5 to 10 year inflation expectations are still extraordinarily elevated, and they remain so at 6.2% among the median of all surveyed participants. The mean is at 3%, which is still above the Fed's 2% target. And so it's just another warning of this stagflationary environment that we're in. We have all these signs of economic slowing at the same time as we still have these elevated inflation expectations. And this is a unique type of a hard landing environment that we are anticipating, and so we believe there's important ways to be positioned for it on both the long and the short side. Let's go on to the next, and why we are so focused on gold today, on precious metals, as well as industrial metals that favor the new EV trends and new green economy, solar panels. That's why we like silver so much, and copper as well as gold. But this is but look, we are focused. Gold for us, precious metals are a macro play, but because of the opportunity in the mining industry and how undervalued in our analysis so many of these companies are, this is why we decided to play this macro trend by starting a precious metals strategy, by partnering with Quintin to help us vet the companies in our portfolio, and we see the opportunity. We believe the deep value, high appreciation opportunity is really on the mining front, because that's where we can create the most value through discovery and through getting money to companies to make big discoveries in a diversified portfolio approach, where when we say at the beginning that we're an activist mining strategy, and we're going to share the good news and the bad news about our discoveries. The way that it works in this industry is making a discovery that's economic is extremely challenging, but it's also highly rewarding. When a company makes a big gold, silver, or copper discovery, it's hard, and yet that is where when you do make a discovery, that is where you catch that early stage of the Lassonde curve, and you can have 5, 10, 20 baggers, or even higher multiples than that. But if we invest in a portfolio of exploration opportunities and we're getting money to these companies to do the drilling, to make the discoveries, are all of our companies going to make discoveries? No, it is an extremely hard thing to do, and that's why the rewards, for those companies that do make the discoveries can be extraordinary, but there's a lot of risk too, and that's why it's important to do this in a portfolio approach and have an expert on our side, an industry veteran like Quintin, helping us to vet the different management teams and target drill projects that we want to go after to try to make these discoveries. And in the 4 years that we've been doing this, I believe we've had a phenomenal track record of making discoveries and getting money to our companies to do that. But we do, but there's a lot of risk, and there's a lot of companies that are not going to have good drill results. Does it mean that we don't continue to support those companies if they're good management teams and if they have other good targets? Well, of course we're going to continue to support the teams that we believe in, but does it mean that we're going to continue to hold on to every company that we've ever invested in either? No, that's not the case. That's not the case either. I mean, we will move on from stories where where we have lost confidence in the management team, or if it was a one target play that the target just didn't work out. We will move on. Or if it's a jurisdiction that goes south, like it did in Mexico a couple of years ago, and we need to get out of our Mexico names, we're going to do that. But when we talk about the different companies on these calls, we're going to be sharing the results. We're going to be sharing why we like the companies, why we like the teams, but we won't shy away either from telling you when there's been disappointing results. And why do we have to talk about the positive news and the negative news? It's because we're an SEC regulated investment advisor, and there's a SEC marketing rule, and this is this is what we have to do. We have to be balanced. We have to share both the positive and the negative. And I just want to be clear that this is how we approach this. But it can be highly rewarding investing in a portfolio approach of exploration stories. A small percentage of winners can much more than make up for the inevitable disappointments that you can have. That's just the way that exploration works.